Good morning, everybody. Thanks very much for joining us. Really interesting session this morning focused on infrastructure. We'll be particularly looking at European opportunities, but also some of that crossover area with real assets, real estate and infrastructure, and really drilling down into some of those topics. Really super panel that we've got here today. And I'd also like to say thanks very much to the Global Listed Infrastructure Organization. Great to be partnering with the organization because there's some really interesting global topics and things that are discussed there. So thanks very much to Fraser and the team there as well. So for those who don't know me, my name's Richard Betts. I'm the publisher at Real Asset Media. We run around 60 to 70 events over the year. Thanks very much also for joining us in the RealX auditorium. On your right-hand side, you'll see that there's options for Q&A and comment. So this is a live session, so please do use the Q&A and we'll make sure that we deal with all of your questions. This is the first time that we've actively covered infrastructure, so I'm really looking forward to an interesting discussion. Super panel, as I said, we've got Thomas Veith, who's leader of the Real Assets for Germany at PwC, Jan-Peter Mueller, who's the Executive Director and Head of Asset Structuring and Infrastructure Investments at Commerz Real, and Copeland, who's Head of Specialist Funds, Real Assets Equity at Aegon Asset Management, Richard Abadie, who's Partner and Global Leader for Capital Projects and Infrastructure at PwC, and Alex Araujo, who's Fund Manager for Global Listed Infrastructure at M&G Investments. So a really good and interesting group here. We're going to start just with a presentation from Thomas, just to give a quick introduction on the market. So Thomas, let me hand over to you.
Yeah, thanks, Richard, and thanks also for inviting me to this initial, let's say, event around infrastructure, which is growing importance. I will just give some high-level overviews how the market looks at infrastructure, and hopefully give some food for thoughts for the further discussion in this panel. So, starting perhaps with a study we initiated earlier this year. Around private markets. It's called Prime Time for Private Markets, and private markets is defined everything that's not listed, and it groups private equity, real estate, private debt, and infrastructure. Of course, private equity is still the biggest piece of this private market, but if you look at growth rates for the next 4 to 5 years until 2025, you can clearly see that infrastructure is the fastest growing asset class within this private markets, as there is so many demand on one hand from investors, but also the need to transform lots of pieces of infrastructure. The second fastest growing universe is real estate, and we also see that the borders between real estate and infrastructure are more and more diluted. As I said, private equity is still the biggest group, but the fastest growing is infrastructure, and I will also make some comments on the ESG part of it. That in all private market, ESG is a much more important piece than we have seen in the last years, and it's not seen as a burden anymore from the investors. It's more seen as a value component which they have to factor into their business plan. And of course, infrastructure and real estate is a diversified risk profile and gives more or less, or should give, a stable return in the future, where a lot of institutional investors are looking for in the current environment. So how is infrastructure defined? This is a pretty wide piece. Usually investors divide it into 4 to 5 pieces. One, of course, is the social infrastructure, covering things like hospitals, prisons, social housing, but also schools and universities. In some countries, of course, they are public. In some other territories, they are going more and more private. A large and important piece is also the transport and logistics. If you look at roads, rails, and ports, but could also be pieces of car parking and logistics, which is also part of real estate. But as I said, it's mixing. The hottest piece currently, what I understand from investors, is of course the piece around energy and renewable, especially the renewable piece around wind and solar investments. It's a growing and important piece, also driven by the green and ESG agenda around the world. And last but not least, a big and important piece, especially if I talk about Germany, is of course the thing around digital infrastructure and telecom infrastructure, which needs to be improved, refurbished, or even built up. 5G, etc., fiber networks, etc. Data centers is something where we need heavily invested, and where more and more investors and specific funds, REITs, are focusing just, for example, on the telecom and digital infrastructure pieces. So a wide range, which makes it sometimes a bit difficult to define exactly what is infrastructure and what not, but you also see the importance of the subsector of private market, and of course the growth and the absolute amount that needs to be invested into this area. As I already said, ESG or sustainability is one of the big topic around the globe. And a lot of investors, as I said, infrastructure is also talking about energy infrastructure, an important piece on the ESG and especially on the net zero agenda, but the same on roads, on mobility, etc. We see a bit of a race for investments, but also around the regulation, starting perhaps with the EU. That heavily started with regulating and bringing the EU taxonomy on the table, and pushing is really, really significantly forward. So for now, I would say the EU globally is a kind of a pioneer in pushing the green, the ESG agenda forward. But for now, we are a bit losing speed because we have country-wise, each territory within the EU tries to also bring the best framework and the detailed framework, because, you know, you have the EU level, and below that then you have the national level where each country has to define how the EU agenda and the taxonomy will be linked into local law. So we are losing a bit of speed. And for example, the UK, also, I assume the UK will use the EU framework in general, but it looks like that the UK will use a much more pragmatic approach to move that forward. And also on the next climate conference later this year in Glasgow, the COP26 conference, I think the EU will try to position themselves very strongly and push really hard on the net zero targets as well on the agenda, but also around the globe. Last year, for example, in the US, there was not so much ESG related or climate discussions. Of course, discussions, yes, but under the older President Trump, it was not so high on the agenda. But since then, in the new Biden government, it's highly on the agenda, and also the US will push hard, especially on infrastructure, on investments. Huge amounts will be invested into transforming the local US-based infrastructure. And also in Asia-Pac, we see some good movements, especially in China with the Green Bond Project. Malaysia also introduced a taxonomy already this year, and Australia is also pushing hard to transform the energy sector from the old coal use into a more potentially hydrogen-based energy infrastructure. So a bit of a race, I would say, around the regulation, but also around the project itself. And we will see later in the discussion, there's enough to do globally, and enough things where investors can invest to transform the infrastructure, the existing infrastructure, and also reduce the CO2 production of the infrastructure assets. Perhaps coming, as I'm located in Germany, some comments on the needs of investments in Germany, just bringing together the needs in the transport logistics subsector of infrastructure. We have to renovate more than 10,000 kilometers of roads in Germany. We have to transform, renovate approximately 10% of the existing rail network. We also have to renovate a lot of bridges and also the rivers as I said, renovate and transform these pieces of the infrastructure in Germany. It's a rough number. We estimate that 300 billion needs to be invested into just this piece with our digital infrastructure. But you already see it's a huge amount that need to be invested. And I think one important comment, just talking about Germany, I think that 300 billion is not the big issue to refinance this amount itself. It's for the public, as it's mainly owned by the public sector. But the key challenge is, of course, the capability in the public sector and the capacity to transform and do this project. I think that's the key challenge for the public sector, to involve private investors and private knowledge into this transformation process. So big amounts on the greenfield transformation, but also on the existing stock. We have already seen relevant large-scale investments into Germany, into companies that focus on infrastructure in Germany. And I think there is much more room for further deals in the next years. As we see the appetite, a lot of international investors are also looking at Germany, of course, at other territories around the globe, because the need for transformation, for investment into the infrastructure is so huge and so big. So I think there will be a bright future, and hopefully this capital, which wants to invest into infrastructure in the next years, will also find a good home around the globe to invest. So that was a quick overview, some thoughts for the further discussion. Thank you.
Great, thanks very much, Thomas. Really interesting, I think, to pick up on some of those topics. Let's just do, and just a reminder to do put your questions in. I see we've already got questions coming in. Thanks very much for that, Douglas. And it's a really interesting topic, and we'll definitely pick that up in the session today. Let's just do a quick round of introductions. Thomas, let's start with you, since you kindly didn't. You went straight in with the presentation, which was great. But just a quick introduction of yourself would be great, and I guess what you're doing in this particular space.
Yeah, thanks, Richard. So yeah, my name is Thomas. I'm a partner at PwC located in Frankfurt. I'm leading the real assets industry. We have 500 staff in Germany, focusing on, of course, real estate investments as well as infrastructure investment. As we see infrastructure at such a growing opportunity, but also a big theme, especially in Germany. We will more and more focus on this topic. We have teams on the ground here, but I think we need to increase the teams, as we see a lot of infrastructure investors are asking us, and we will in the near future cover all these themes with our teams. And I'm a deals partner, more focused on real estate, but more and more also focused now on infrastructure.
Yeah, and it's interesting, that crossover, I think. Anne, quick introduction of yourself.
Hi, I'm Anne Copeland. I'm a fund manager at Aegon Asset Management, and I've worked in the real estate sector since 1995, and specifically on non-standard real estate, so what we call noir, so not office, industrial or retail, which has covered areas like PFI, regeneration, healthcare, and sort of picking up on Thomas's themes. We see what we do as social infrastructure and impact investing. So there's a neat tie-up that perhaps we can come on to later.
Great, thanks very much, Anne. Alex.
Good morning. I'm Alex Araujo. I'm a fund manager at M&G Investments. coming up on 4 years ago, we launched a global listed infrastructure fund to, in many ways, democratize the asset class and allow everyday investors to be able to access this exciting asset class, as well as traditional institutional investors looking for liquidity that listed infrastructure provides. I'm a real asset obsessive, always have been, and we invest across the traditional infrastructure areas as well as social and digital and evolving infrastructure assets.
Great, thanks very much. Jan-Peter.
Hi, everybody. Sorry, I was on mute. Jan-Peter Mueller, my name. I'm head of infrastructure investments at Commerz Real, and they're responsible for mainly 3 areas of investment. That's transport and mobility, that's networks, where we talk about fiber, but also about energy networks, and that's renewable energies. And at the same time, I'm chairman of the supervisory board at Veith, which is one of the biggest offshore wind farms in the German North Sea. Commerz Real in general has, I think, 35 billion of assets under management. We invest into real estate, but also into infrastructure. And we manage and hold funds for retail and institutional clients alike.
Great, and I think we should set a challenge for everyone watching to be able to guess what that is in your background behind you, and then we'll reveal it in 5 minutes. Thanks, Peter. Richard, over to you.
Yes, I think you can guess my background. It's not my house. We are back in the office at PwC in the UK. So Richard Abadie, I'm a fellow partner of Thomas's. I work out of the UK. I lead our global infrastructure groups. I don't cover the real estate side, although I fully understand the crossover. At a personal level, most of my time is spent around debt structuring rather than on the equity side of the business. But in my global role, our wider team provides M&A, debt advisory, deal strategy, evaluations, diligence, tax structuring, you name it, across the infrastructure space. We've probably got 2,000 to 3,000 people working in infrastructure on a global basis, and that's growing pretty quickly at the moment as the market grows as well.
Super, thanks very much, Richard. So why don't we start with you, Alex? Just in terms of, there's a lot of focus, obviously, because of the pandemic in terms of Build Back Better. And we've seen a lot, particularly in the real estate side, real asset side. I suppose, how do you see the market over the past 12 to 18 months in that infrastructure area? Have you seen major changes, shifts in terms of the key trends?
Well, we certainly have. We've come through a pretty dramatic economic and a health crisis, and I think for the first time outside of reconstruction following, for example, a world war, we've got very much a globally coordinated set of efforts, both by way of monetary policy and fiscal stimulus and government policy to reinvigorate economies. Much of that is centered around infrastructure, whether you're talking about Biden's plan, whether you're talking about Europe's Green Recovery Plan, and even in Asia, where there's a focus on building infrastructure. It obviously benefits society to do so over a very long period of time. We know that from the last time we went through these types of programs. And this time around, it's very much built around sustainable recoveries, which in many ways means a sustainable energy generation rather than what we did the last time we had a big crisis in a financial sense, which was subsidize the banks and bail them out and so on. So it is quite striking. I think it is very, very powerful. There's a lot of money being thrown at the efforts to rebuild, and much of that, of course, built around infrastructure and the jobs related to it. And depending on the region, with different areas of focus, because the US has a very different set of objectives than, say, Europe or China, although they do have a lot in common at the same time.
Great, thanks, Alex. And Jan-Peter, just coming to you, any views on that, of course, but also, I guess, we mentioned there a little bit sustainability. How important, how key is that for you?
Well, I think you can't deny that there was a huge economic downturn and that there was a huge economic impact of the corona crisis. What I find interesting that if you look at infrastructure assets and specifically at energy networks, but also at energy generation sites, which we are running, then that downturn was by far less significant, simply because I think infrastructure there has proven that it is quite stable. So all the attributes that it was always thought of, with a very low Sharpe ratio, very low correlation to the general economic cycle, it has proven that it can bring that to the table and that it actually is able to deliver, also in gigantic crises like this one. That may be the one. And what comes out of that is that there is an increasing demand for especially renewable assets, but also impact investing. And that is what we are seeing and what we are feeling, that on the one side, the asset generation or the asset acquisition gets much more difficult because there are a lot of more players which are now entering the market and which are trying to get a piece of the cake. And on the other side, that's of course wonderful, because if you look at the numbers, we say that we need 5 to 7 trillion a year in order to reach the 1.5 degree goal of the UN. And so we need the private markets to step in, and we need the private markets to come forward and to invest into impact investments. And we see that need as well, and for us it is essential. So we also launched an impact fund in October last year, which is only investing into assets which actually do have a provable positive impact. So it's something very close to our heart, or where we see the future of us investing as well.
Good. And from your point of view, Richard, I suppose looking at some of those kind of key trends, how do you see that crossover between real estate and real assets, particularly?
I think Anne touched on some of them quite well, right? It's what I'd call real estate plus when you look at the crossover. You're into regeneration projects, you're into city-based projects, you're into decarbonizing buildings for the sake of argument, you're into domestic and localized transport and energy generation and efficiency. So I think real estate investors see that as almost the first degree of separation from their core sector. I think if you're going into some large-scale wind farms in rural areas, offshore wind, it makes it just a little bit different. It's not real estate plus, then you're into pure play infrastructure as an investment class. I think that'll be one of the questions for many of the investors as they get into infrastructure, diversifying slightly away from real estate, how far they want to go. As all the speakers before have said, there's a huge opportunity, there's a tremendous need. I think the one thing we haven't touched on, which I think is applicable both in cities, environments, and right across countries in the world, is just maybe the impact of technology. A lot of the energy efficiency and decarbonisation agendas are technology driven. If you look at traditional infrastructure, low risk, low return, low Sharpe ratio, essentially, as Peter was saying, the technologies don't necessarily fit neatly because they're volatile. You can get obsolescence. There's a degree of uncertainty in them. So I think what we're going to see is an increase in collaboration between governments on behalf of the taxpayer, private capital, technology companies, and also when you look at funds in particular, not just the infra side of the house, but maybe the VC side of the house and the PE side of the house, because those lines are blurring as we start increasingly investing in new areas. Nothing to be scared of, but just again, if you're coming out of a pure play real estate fund, it can be quite intimidating, and to sort of position yourself into which bit of the infrastructure risk dimension you want to put yourself into.
Yeah, I'm going to come to that topic around capital shortly and what the capital is looking for. And just in terms of your perspective, you were agreeing there with a lot of what was being said, particularly around the sort of impact side of that. Is that what's driving your fund there in terms of the social infrastructure side?
It wasn't the reason for setting the fund up originally. I've worked particularly in healthcare for nearly 20 years, and the reason behind setting it up was it was a way of giving quite high distributions, high dividends. Rents were linked annually to RPI, to our rate of inflation, with caps and collars, and so it was actually quite a defensive play in that the standard deviation return was in a very narrow band. So when the market was racing, 2004, for example, the market was bonkers and we all thought it would collapse, it would collapse, it would collapse. It didn't. Healthcare didn't see those really aggressive 25% capital changes that we saw in some other sectors in a quarter. But what it then didn't do on the downside, it didn't see the falls. And actually clients, one of my mantras for my clients is, I will try not to surprise you. And it may sound boring, but surprises tend to not be good. It's very rare you call a client on the off chance and say, can we have a catch up, and it be good news. And actually for the last sort of 20, 30 years, healthcare has had its ups and downs, but it's been a really strong performer. We've given our clients net returns over 10 years of 10%. We are able to demonstrate that for every pound or euro invested by clients in the sector, we can monetize that in terms of the social impact of their money, the job creation to folk who are marginalised. So it really, it's sort of merging. I suppose Richard was touching on that scary territory of real estate folk going into infrastructure. Well, this is a sort of stepping stone. And in fact, some folk in infrastructure might come the other way to real estate, and it's a stepping stone in the other direction. What I would say is, I agree on the low Sharpe ratio. A lot of what I focus on is underlying operational businesses, both public sector and private, and technology. The good thing about real estate compared to infrastructure, in some cases, we don't have the same obsolescence. I've got pretty standard buildings that are brick built. But what I have, it's all about the delivery of the service in that building. And actually technology in like telemed, telehealth is really cheap and really innovative and really changing. So actually in this slice of it, you get the benefits of the technical advantages, the efficiencies, without perhaps the drawbacks of going, oh blimey, you know, I know nothing about wind farms, but it may be that the wind farm of 10 years' time looks rather different to the wind farm of today. And boy, is that a big capital investment to change that estate of infrastructure. You don't get that in some of the social infrastructure, sort of healthcare operational businesses. Not to say you get you don't get a rocky ride occasionally, you do, but it's a nice bridge between the two, I feel, for clients.
Okay, good. We'll come to that point around the investment side, I guess, into those larger scale infrastructure ones. I just wanted to pick up a question that had come in from Douglas Edwards. Douglas, good to see you this morning. Thanks very much for joining us. And Douglas says, I'd be interested in hearing the panel's view on the use of the wider definition of infrastructure under Solvency II to allow greater investment in real estate related social development. So I don't know whether anybody wants to pick up that particular topic, or you can have a chance to think about it and come back on it later. Any views on that one? Douglas, we'll come back to that one. But I think that element of the focus, I guess, in terms of the tax, the regulatory side, Thomas, in terms of pushing much more towards wellness, well-being, social infrastructure, carbon reduction, sustainability, those sides must be a driver as well for infrastructure, as well as for as well as for the real estate side.
Yeah, absolutely, Richard. That's a key driver. I think I'm not the solvency expert, but I would say that the regulator has also to follow this investment trend. So if we see that the crossover of real estate and infrastructure, I think is something, of course, institutional investors are partly already investing in and have invested for a long time yet, but it's a growing piece. And if that merges more and more, I think then the regulatory framework has to change on the investment classes. So I think it's pretty clear as the correlation, as we heard, is pretty similar. It's a stable cash flow. It's a built environment piece that will follow. And the same is around the ESG. I think from my roots, I'm more a real estate person. I see how the ESG, the measurement of ESG, and the transformation of organizations into ESG-focused, impact-related organization that's moving pretty fast. I think as infrastructure is a wider definition, there are so many subgroups in. I think it will take some time also to have a clear clear and consistent framework of also measuring CO2, for example, but also the social and the government pieces in infrastructure investment. I think that important, and I'm pretty sure that will follow, as Jan-Peter said, some of the infrastructure pieces like wind parks, and so they are already impact investment as they reduce carbon emission already, and that's what the Impact Fund, which is regulated under Article 9, the highest class under the EU regulation, this Commerz Fund, which was launched last year. So I think that's the future where everyone wants to move. And I started in my presentation that I think there is a need independently of ESG to invest into infrastructure. Some of most of the bridges and the tunnels, for example, are more than 100 years old in Germany. So they have to do. And now there's also the opportunity on top of that to transform this infrastructure into a green investment, which even makes it much more interesting. And most of the pieces have a green element on infrastructure. So if you transform energy, is per se green. Of course, if you do the wind or solar investments, it's the same with street, etc. It will all reduce CO2 emission. And that, I think, the good news that it's not so difficult to combine infrastructure investment with a green angle without greenwashing. And so, because you can change so much with smart infrastructure investment. So that's good, and that will change the market definitely.
Yeah, good. Thanks, Thomas. And I'll pick up a little bit on that, drill down a little bit more into the energy and transformation side, because I think that's a really interesting point. Alex, I just wanted to pick up with you, and also maybe with you, Richard, afterwards as well, just in terms of that, the global view, if you like. Alex, how do you see European opportunities within that context? And also, I suppose, the flow of capital. Is US money targeting Europe, European money targeting, US, Asia? Are there any particular trends that you're seeing?
Well, I do manage a global fund, and there are opportunities around the world. They can be different. They can be unique. Europe is particularly interesting because of the coordinated efforts and centralized approach to the recovery, which is very well known as the green recovery, and some of the very specific targeted areas such as renewable energy, electrification of transport, potential for a hydrogen economy, energy efficiency in buildings, and so on. And so there are infrastructure opportunities around all of those things. In the listed realm, there are some great opportunities. And remember that as an equity investor in the listed realm, I can take advantage of market opportunities where valuations become attractive. And we have in Europe some of the most attractive valuations within listed infrastructure globally. And we have at the same time the incentive mechanisms, the subsidies, it's the European Recovery Fund, for example, that are driving the approach. And you can't do any of this without private capital being involved. So you've got a framework. It's well coordinated. It is real, and it is incentivizing capital investment, the returns on that capital investment, and ultimately the equity returns that you'll ultimately get as an investor. And so we've got, if you look at our position positioning versus a global equity geographic allocation, we are actually overweight Europe within our strategy. Not to say there aren't other opportunities elsewhere, because we have a significant exposure to North America and to Asia as well, but Europe at the moment has some very attractive opportunities in the listed realm.
Okay, great. And Richard, do you want to pick that up from your perspective there?
Everybody wondered why I went dark all of a sudden. It's PwC's energy efficiency strategy in our buildings. Our lights turn off every 5 seconds. So if you see me waving my arms, it's not to try and get attention. Lights. Yeah, so I think it's a great question on a global basis. Maybe just to add something slightly different to Alex, although I agree with everything he said. The globe's a big place, first of all. You've got to differentiate broadly between greenfield infrastructure, and a lot of the stimulus that's being talked about at the moment is going into essentially new build or retrofit. There's risk with that. I mentioned technology earlier. There's construction risk, there's price risk, there's completion risk. There's a segment of the investor class that's interested in that risk. There's also a big chunk of people that want nothing to do with it. So I think there may be a little bit of a lag effect between the stimulus that we're seeing at the moment and the actual tsunami of private capital coming in to back some of this stuff, unless governments intermediate or venture capital starts intermediating some of this stuff. If I just park that just to the side, but it is relevant for investor appetites on a global basis. Where you see these big programs, I fully agree. Europe's very popular. I think most portfolios would be overweight Europe, just given the opportunities that are coming out. I'm hearing in the US in particular that some of the funds are a little bit grumpy about Biden's deal because they don't have line of sight to investment opportunities themselves. BlackRock's commented on that very, very recently, just saying that more should be done to attract private capital in there because these governments can't do it themselves. And if you go to the OECD countries, not unilaterally, but there are opportunities there. I think if you go to some of our emerging markets, that's a totally different proposition. Often they fall out of the sort of OECD countries. A lot of it's greenfield, a lot of it's relatively high risk, currency risk, whether you can move currencies in or out, whether you can get security of legislation, regulation, and those type of things. And if you speak to some of the multilateral institutions, that's where a lot of money is needed as well. So when you talk about the globe, I think if you're talking about developed markets, there's an ecosystem that works relatively well and you can move your money around. When you start going into the emerging markets where a lot of the growth and investments actually needed, it's a much tougher proposition. But the bottom line is capital supply exceeds available projects and investment opportunities. So I don't see that changing for the foreseeable future as the Infras and asset class continues to grow. So I would expect there'll continue to be yield suppression, high prices, but stability in the returns and the like going forward.
Okay, good. And Jan-Peter, maybe let's just pick up on, I suppose, the prospects, the trends, the opportunities as we drill down a little bit into that infrastructure side. So, I mean, in terms of areas like energy transition, data, those kinds of things, well, I suppose, what are you seeing there?
I think there's vast potential for. I mean, the Energiewende, as you call it, or the big change is only going to come if you have the transmission right, and if you have the storage, and if you actually have the ability to move the energy from the places where it's produced, which is going to be a large part of it, at least in the future, offshore to onshore, and often it's in areas where there's not that much economic development, and you have to bring it to the places where there's a lot of economic demand also for that energy. So I think there's a lot of potential, or there's a lot of money needed, at least in this energy transmission networks and to invest into them. I'm a little bit afraid that the government schemes behind it and also how government are running them isn't really efficient, that it doesn't get done fast enough, that there is in our Western democracies, which on the one hand is good, but on the other hand, there's this not in my backyard feeling. So I'm all for green, but please don't build the wind park in my backyard, which I understand on the one side as well, but on the other side, what's the alternative to it? So I think that is one area where there will be a lot of money that is needed. And the other thing, of course, is data centers. They need a lot of energy. Again, that energy is supposed to be green. If you look at the power purchase agreements that Google signed, that Facebook is doing at the moment, that Amazon is looking at, then you see that there's a lot of demand in order to also feed that hunger for energy, basically. So I think we're going to see a lot of new investment opportunities and a lot of more demand for those investments.
And Alex, from your point of view, are you seeing any particular trends, I suppose, in terms of the flow of capital, in terms of the listed side into some of these specific areas where, are people more looking at data centers or data? Are they looking more at transportation? Are you seeing any kind of trends emerging there?
Well, we take the capital and then we allocate it where we see the opportunities. But it is definitely true that the market generally has been rewarding some of the faster growing infrastructure businesses, and digital infrastructure is, of course, at the core of that. We've been invested in data centers, fiber optic networks, mobile phone tower businesses since we launched the fund. They've done extremely well for us. These are structural growers. They tend to grow regardless of the economic cycle. And of course, they would have been extremely resilient in the past year when the broader economy was under significant pressure for all the reasons we know, having to work from home and entertain ourselves at home and so on. So that's a core part of our portfolio. We have a dedicated allocation to that. But remember that the winds do shift and opportunities arise in other areas. Think of transportation infrastructure, airports, toll roads, public transit. In the listed realm, the valuations of these kinds of businesses became very, very attractive for us, and we were able to reallocate capital in a listed strategy that makes use of the liquidity of underlying markets. So we can move where the opportunities present themselves. We can be very nimble and flexible without abusing that privilege, because we always have to keep in mind that we are investing for the long term in real long life fixed assets with very long term cash flow generating potential over time. I think that more recently, in the listed realm, it's worth highlighting that I think in large part because of ESG-related fund flows, the money's gone straight for the cleanest of the clean, the pure renewable energy generation businesses. It's a path of least resistance. It's very straightforward. It's uncontroversial. And as a result, the valuations of these businesses in the listed realm became extreme. And have since come under significant pressure. So we see better opportunities in transition businesses that are transitioning their own energy mix, for example, away from fossil fuel generation towards renewables. More complicated to analyze. You have to engage with the companies. You have to do a lot of work around them, but those are where the opportunities are. And to Jan Peter's point, especially, for example, in a place like Germany, where policy decisions have been made around nuclear and coal-fired power, there's significant investment required, not just on the renewable side, but on networks. And one of our investments, interestingly enough, is very active in reconfiguring, rebuilding both the high voltage networks in Germany to accommodate the renewables and the new approach to energy generation in the country, as well as specifically in Germany on low voltage networks, which need to be smarter and need to be reconfigured as well. So some areas that aren't exactly obvious to people where we see significant opportunity.
Okay, good. And in terms of in terms of the markets and geographically, where are you invested? And I suppose what's driving that in terms of your fund?
For me, it's where the regulators are welcoming, where the allowable returns are generous enough to give the companies the opportunity to grow their cash flows and their dividends, and where there are policy initiatives, where there are unique opportunities to invest in infrastructure to accommodate the needs. So let's talk about Asia, for example. It's a different proposition than elsewhere, where new exciting infrastructure needs to be built. Think of of China, high-speed trains and airports and renewable deployments. I mean, China needs to displace a lot of coal-fired power and coal-fired heat to replace it with transition infrastructure, with renewables directly. America needs significant investment to improve its roads and bridges, which is at the core of Biden's plans, because it's not just an issue of inconvenience, this decades-old infrastructure, it's an issue of public safety, and at the same time, renewables part of the story. And as we discussed earlier, Europe very much built around green recovery, and that's where the at the micro level, at the company by company level, the opportunities arise. Always opportunistic, always country specific, regulator specific. So it takes a lot of work, but then ultimately you end up with a concentrated portfolio of businesses that could capitalize on all of these things across the world.
Great. And just coming to you in terms of that geographic side, I suppose, where are you investing and what's driving that?
I think a bit like Alex, we focus on where the capital flows are, where the interest is, and really firmly, the UK is a very well understood marketplace, very transparent. Little, I won't say no corruption, but little corruption, fairly stable in terms of its political situation. And for social infrastructure, I think we can probably say we know that the private sector needs to be involved because the state sector is not allocating sufficient capital across the piece. We'll all have examples of where that's happening on the news last night. We have a hospital where it's being physically propped up by axoprops because the roof is caving in, and it's just along the road from Sandringham where the Queen has her residence, and it's not safe for staff, not safe for care. It shouldn't really be a case that we've got a roof of a building potentially falling down in a developed economy. So our investors do like the UK market. Actually, they're investors from the US, from Europe, from the UK, and from Asia. And actually, they're a really educated bunch of clients. They appreciate that we don't just focus on heritage locations. And in fact, some of those, what I'd call sort of more glamorous cities and towns in the UK, are ones where the social impact, the underlying businesses would even struggle to staff those locations. So it's wonderful building a facility in a location, but if it's frankly a bit too posh, you haven't got a workforce because they don't need a job. So I think it's taken a while for overseas investors to appreciate that the UK isn't just London and it's not just the key cities. And in social infrastructure, you need to go even broader than that because some of these needs are national and international. They're not just based on a few locations around the world, a few big cities. What I would say in social impact investing from my direct experience is we have had 100 payment of all rent and rental increases during the pandemic. And I don't think there have been many funds that can say that. In probably the most challenging time ever for things like end-of-life care sectors, where you would expect if any sector was having problems, it would be this sector. No, all rents paid. If we look to the listed space, look to the REITs that performed well, it's GP surgeries, it's healthcare, have traded near to or well in excess of their NAVs. The appetite from investors is off the scale, to the point that some clients will probably be looking to take their capital off the market and realise their profits from their patients have been invested in the sector when it wasn't sexy over the last 10, 15 years, those early movers. But with, from real estate side, these sectors often offer very long income streams, so 30, 35-year leases. So again, we are getting quite close to some of those infrastructure transactions. So it's not quite the brave leap that perhaps some thought. It's not 5-year leases, and it's very long, very stable, can demonstrate the strong impact. And from that, we've therefore got a client base who are really keen internationally. And the challenge is I've got a number of investors who, on acquiring portfolios, have come second or third every time, and they've just been picked at post. So it's the dearth of opportunities is the issue, certainly in the UK market.
And Thomas and Jan-Peter. Thomas, what are you seeing, I suppose, in the German market? And Jan-Peter, I'll then come to you in terms of what your experience is.
Yeah, I can start. Of course, there are lots of opportunities coming up in the healthcare sector more and more, as well as in the energy transformation piece, where Jan-Peter can talk much better than I do. The healthcare piece was partly privatized over the last, I would say, 10, 15 years, but there's still a strong impact from the public sector. And I think on the transport side, as well as lots of energy-related pieces of infrastructure are still pretty, and the motorways, etc. It's all public sector, but that's part of the, let's say, opportunity, but also of the challenge, as the public sector or the digital infrastructure has a huge need. Every international board will say, look, Germany has to do a bit more and has to invest more. And the public sector now understand that it's not just about money, which is a little problem, but not a huge problem. It's really about having the capability to do these investments and the knowledge and the capacity to really have the technical knowledge to do and to transform, to invest into this type of infrastructure. And that's something which is a growing understanding in the German government and also on the local areas, on the city level, etc., to really involve more and more private capital as well as capabilities, capacities, which the public sector really needs. But still, compared to, for example, UK, we never have this big privatization wave in Germany yet. It's public sector is still strong, but public sector is moving in the right direction to understand that private support is needed.
Great, good, thanks. And yeah, Peter, just in terms of some of the geographies there, what are you seeing in terms of the opportunities?
Well, due to Europe's Green Deal, we see large opportunities in Europe. Of course, if you look at the International Energy Report, I think they speak about 44 gigawatt in 2021 and 49 gigawatt in 2022, which are being built in Europe. Then you see the PPA market is growing tremendously. So I think there will be a lot of opportunities, not only in the traditional markets like Germany or the UK, but also we see a lot happening in the Nordics and of course in Spain and Portugal. Italy is coming back. So I think Europe is going to be the main focus, but of course if the Biden package actually comes through and passes as thought of, then I think the USA is going to get tremendously interesting. You're going to see a lot of opportunities coming up there. We are currently looking at a couple of projects. Canada is still interesting for us. We have looked at a couple of projects in Australia, Taiwan, of course, and Japan. So I think our main focus is going to be Europe, simply because we're still more on the core plus side of investing. Then there comes US and Canada, and I think then you can look at for at least European investors, a little bit more far away locations like Taiwan, Japan, Australia.
Okay, great. We've got around 2.5 minutes left, which gives us kind of 30 seconds each on where we see the opportunities now, and I suppose over the next sort of, let's say, 5 years. So where are we seeing the biggest opportunity? Richard, let's start with you.
Energy transition. It's I've gone dark. It's coming back again. Really the early stages of the energy transition agenda. I think early movers into some of the technology, early movers into some of the sites, and be it hydrogen, carbon capture and storage, alternative fuels more broadly. Quite exotic investment, but that's what's going to set the tone for the next 30 years as we try and hit net zero 2050. And first movers into that sector taking a little bit of risk, I think will get massive returns in the long run.
Great, thanks. Alex?
Well, I won't disagree with energy transition. It's a multi-decade opportunity set. And interestingly for me, it's actually the listed utility sector that is at the heart of the opportunity set. And that includes electrification of transport, so charging networks and so on, which we didn't talk about. As Anne has highlighted, a huge need for social infrastructure investment. We know this from the experience of the past year. That's part of the opportunity set. And one cannot ignore the ongoing requirements around digital infrastructure, not just in the developed world, but as emerging markets, as developing economies become increasingly connected to the internet for knowledge, for learning, for understanding, for work, and so on. So it's a multi-part opportunity set, and there are many others. So you asked for one, I gave you three. I apologize.
Excellent, thank you. And what about you?
AI definitely, and telemed and telehealth.
Okay, brilliant, very good, very succinct. We like that, Anne. Thomas.
Yeah, well, as we learned, infrastructure is a complex beast, but I would focus perhaps on the hydrogen transformation as well as the data center digital transformation. I think that's the two key points.
Great, super. Yeah, Peter.
I think all of these asset classes are perfectly right, and I couldn't agree more, but I think it's driven by impact investment. And that's simply because also if you look at the numbers, the 23 to 39-year-olds, they will own like 40 trillion, I think, in assets under management over the coming years, and they are much, much more sensitive to the topic. So all the asset classes that were mentioned, they will all have to deal with how can I do it and at the same time have a positive impact.
Great, and you should also let everybody know what is the picture behind you, Jan-Peter?
Oh, it's an offshore substation in the German North Sea of our offshore wind park, Veja-Mate.
Excellent, very good. You definitely had to tell me what it was, so thanks very much. Really interesting discussion. Great for me to learn more, particularly about this infrastructure side and some of the similarities with real estate as we begin to cross over in terms of real assets, I think. Thanks very much to everybody for joining us. Thank you for your questions. You can visit the rest of the exhibition after this. You can connect with one another. You can also download the slides from Thomas. We'll share those, and we'll also make this available as an on-demand recording. So if there were colleagues or industry partners who you think would benefit from watching it, then we'll make that available to them as well. This is designed to be the first of 4 of these. So Alex, you're absolutely right. We didn't get a chance to speak in depth about a number of those areas, and we'll be having special focuses on those different areas as we move through the year. So please do look out for those. And for anybody who's interested, particularly in the social impact and affordability side in terms of residential and also affordability within cities, including that infrastructure side, then tomorrow we've got a focus on affordable cities. So do feel free to join that one. Thanks very much to the speakers. Thank you for joining us, and look forward to seeing you at the next event. Thanks very much, everybody.